If you own shares of Zoom Video Communications, it probably feels like you can't catch a break over the last 2 years. The company reported earnings last night and shares are down about 6% as of the time of this filming. But were earnings that bad? Actually, no. There was a lot to be excited about, but there was one detail that gives shareholders, including myself, reason to pause. Let's go over all of that in the next 10 minutes. My name is Brian Stoffel. As the time of this recording, I do own some shares of Zoom Video Communications, and thank you to YCharts for sponsoring today's video. More from them in just a second. So if we look at this was the company's first fiscal quarter of 2024, and Zoom is now a $20 billion company. On the top line, growth was pretty anemic, but we'll get to why in a minute. It was just 3%, but that beat Wall Street's estimates and management's guidance. And it was the same story on the bottom line. Non-GAAP earnings, which excludes stock-based compensation and some other things, actually grew 13% and also came in pretty well ahead of Wall Street's and management's guidance. If we look at margins, there was a lot to like there as well. Gross margins expanded meaningfully on a non-GAAP basis because of the company's utilizations of their own servers. Operating margins also expanded thanks to that to 38%, and net margins are phenomenally high on a non-GAAP basis of 32%. And it was pretty much good news if we look at the rest of it. Net income was up ever so slightly on a non-GAAP basis. Free cash flow did fall, and we'll get to that in just a minute, by about $100 million. And the balance sheet has about $5.6 billion in cash and no debt. So it is in very healthy shape when it comes to that. Now, let's look at some metrics. We're going to start out by looking at enterprise customers. And we need to take a second and just pause, because we are used to thinking of Zoom as a company that we use to communicate with grandma during the pandemic. But the fact of the matter is that was a huge, huge boon to the company during the pandemic. But this company was never meant to be used for that. It just happened to be the right tool at the right place at the right time to help us communicate during a pandemic. But this was always meant to be a business tool, not a personal consumer tool. And as time has gone on, people using it to talk to grandma have gone down, which makes it look like the business is doing really poorly. But in terms of what it was always intended to do, to help businesses connect and hold meetings, it's actually continued to improve. And that's why these enterprise or big business customers are so important. So let's get back to that. And we can see that those enterprise customers ticked up by about 9% from the same time last year. We can also see that the number of customers contributing at least $100,000 in revenue also jumped more significantly, 23%. Both very good signs. The net dollar expansion rate for those enterprise customers was 112%, just a hair lower than it was in the last quarter, and that's good. It means they're holding on to their customers, getting them to spend 12% more per year. Now, overall revenue from enterprise customers was actually up 13%. And that tells you that those online customers, those people who used it to talk to grandma, they're the ones that are dragging things down. The average churn for online users, and that is the consumers that are using it, they're still churning, they're still leaving, but the rate of their churn fell to 3.1% during the quarter. So again, those people are still leaving the platform. That's not surprising. It was never meant for them, but that is the drag on revenue. The company said they were able to push through a price increase for their enterprise customers, and those online customers, people, individuals like you and I, that part of the business is actually stabilizing sooner than expected. So that's good news as well. Now, it is important to note that they grew 8% in the Americas, but they saw revenue decline in Asia Pacific and Europe, the Middle East, and Africa. The company said that Europe, the Middle East, and Africa was due to some of the headcount cuts that they made, the war in Ukraine, and a strong dollar. The decline in the Asia Pacific region was almost just because of the strong dollar. If that means they're holding on to the customers, but what they're getting paid is worth less because of currency conversions, that's not a long-term concern that investors should be worried about. Now, this was very encouraging as well. Total remaining performance obligations, which means the amount of money that they have contracted, was up 16%. That's a lot more than the 3% revenue growth we saw during the quarter. That's great, but it came with a rub that we'll get to in just a minute. If we just go down the income statement, there was a lot to like. Gross profit, as we said, went up. It's worth noting that R&D expense also increased faster than revenue. They're investing in the future. They talked about call centers and AI. Their sales and marketing also grew faster than revenue, but just ever so slightly. It is good to see that they were able to cut expenses for general and administrative, and overall that led to an operating profit margin widening of about 1 percentage point. Now, it is worth pointing out that as they build this out, there are some things to note. And this would be the one thing that I would say might be cause for a little bit of concern. Deferred revenue actually fell by $100 million from the same time last year. They still collect this money at the same time, and that raises something of a yellow flag. They said that the reason for that was shorter contract durations in enterprise deals arising from uncertainty in the macro environment. And they expect deferred revenue to be down about 3% year over year, which takes into account this recent trend of shorter durations on the enterprise deals. Now that is important because that calls into question the company's moat. Everybody knows that Microsoft is the big competitor, and you got to believe that Zoom has high switching costs and a better product, which will keep the customers there. Shorter contract durations from those key customers in the enterprise is something to watch. It is a cause for concern. It is something that we need to keep our eye on. Just moving through the rest of it, it is worth noting that stock-based compensation did increase to $280 million, about 25% of revenue. However, because of share buybacks, shareholders have not been diluted on an absolute basis. The share count is actually down about 1%. Now, in terms of guidance, management guided in the midpoint ever so slightly ahead of Wall Street's estimates. On the bottom line, $1.05 is the estimate. If we look at full year, management raised the guidance. The midpoint now calls for 2% growth, about $25 million ahead of Wall Street's estimates. Earnings per share also expected to come in ahead of Wall Street's estimates based on the forecast. So what should we watch moving forward? Well, first, keep an eye on the enterprise dollar-based net retention. It was at 112%. Keep an eye on those operating margins. It'd be nice to see the sales and marketing come down so that it's growing as fast as revenue. But really, keep an eye on that deferred revenue. That is something that I'm going to be watching really closely because those contract durations shortening does worry me. It calls that moat into question. And I'm also going to keep an eye on remaining performance obligations. Overall, I'm just going to say that the moat is stable. More stable than widening. The thesis is still on track, but keeping an eye on that deferred revenue might make this a greenish yellow flag moving forward. Overall, this got a 10.5 on my anti-fragile score. However, we need to think about valuation. And to do that, we need to ask ourselves, what stage of growth is Zoom in? And I would say it's between stages 4 and 5, which gives us a couple of different things that we can use. And for that, we're going to turn to Y-Charts. Thanks again for Y-Charts sponsoring today's video. If you want to give Y-Charts a try, see the link in the notes below and you can get 20% off by mentioning Brian Feroldi's name, and you can start a free trial. Now, if we look at the PE ratio on a GAAP basis, that doesn't really tell us much because stock-based compensation is such a big deal. But if we look at the forward PE ratio, and this is on a non-GAAP basis, Zoom's trading for just 16 times its forward earnings. That is the lowest point it's been in the past year, and I can pretty much guarantee you the lowest it's ever been as a publicly traded company. And that seems fairly reasonable. If we look at its price to free cash flow, it's trading at about 17 times free cash flow. Again, that's pretty reasonable. We can also even look at the shareholder yield, which is a really neat tool that Y-Charts has. And you might ask, where does a shareholder yield come in? Well, Zoom has actually returned a lot of cash to shareholders in terms of share buybacks. So that is there as well. And it's actually a 4.5% yield right now. The other thing that you can see that we can look at is a reverse discounted cash flow model. And to that, we'll go to a tool that Brian Feroldi, Brian Withers, and I have constructed, and it's actually quite simple to use. All you do is click over here, you put the ticker in, which is Zoom, you put its free cash flow over the trailing 12 months, you pick a terminal growth rate. 2 seems reasonable to me once this enterprise hits a certain steady state. I'd put the discount rate at about 9% because this is fairly reliable. And then you just got to play right here with the growth rate. If we say a growth rate of about 6%, or let's say even, 5%, then what we see right here is this is a 5% discount rate. These two numbers match. And so we see that if you invest in Zoom right now, what you're saying is over the next 10 years, if you're asking for about a 9% return per year, you need to see that free cash flow grow at about 5% per year. Is that doable? Well, right now, free cash flow has actually been shrinking. As enterprise takes over as the bulk of revenue, it should be able to expand, but we have to wait and see. So if I were to go back and readjust my own scores based on this, I would say it was at a 10.5. I would put it here in terms of how reasonable that assumed growth rate is, which would bump it up to an 11. So overall, there was a lot to like in this quarter for Zoom. That deferred revenue, those shorter contract values, they are a cause for concern. That is something I'm going to be keeping my eye on. If you like that reverse discounted cash flow tool that I showed you, if you click in the show notes below, you can get it absolutely free, and hope that helps. We'll check back in on Zoom in 90 days. Until then, Brian out.